It's no surprise that the stock market's been crashing for months now. If you look at the S&P 500, the Nasdaq, or the Dow Jones, all three of those different stock market indexes, they've all been dropping lower and lower basically every single time you look at them all year long. And if you want to look at how much these indexes have dropped, the Nasdaq's down around 30%, the S&P 500's down 20%, and the Dow Jones is down over 15% all year to date. And now what's special about both the Nasdaq and the S&P is that those markets are officially in what we call a bear market.
As I've been saying for weeks, I think we're in the midst of a real bear market.
The market is in a bear market.
Are we headed into a bear market?
Now, bear markets are usually the term that people use to describe the stock market when it's dropped 20% or more from its recent peak. So right now you'd say that the Nasdaq is in a bear market, the S&P 500 is in a bear market, but the Dow Jones isn't right now. Now, you'll probably just hear people saying in general that we're in a bear market overall right now, and that's because at least two of the major indexes are in one. But technically it is index or stock specific, not the overall market. Now, here's the thing. A lot of people started investing for the very first time in the last 2 years. Like literally 60% of investors between 18 and 34. So that means they started investing during one of the biggest short-term growth periods in the stock market history. So if you start investing and see yourself making all this money and then all of a sudden we're in this bear market, you can kind of see why there's going to be a lot of panic. But bear markets aren't new. They're actually a really typical part of what we see happen in the economy, and there's been a lot of them over the last century. Now we're going to get into all of that, including the history of bear markets and how you can invest while we're in one right now, and we're also going to talk about bull markets too. But let's not get ahead of ourselves. First, after you like this video down below, because it really helps us out and it helps the channel out a lot, and we really love to see it, then we'll jump into this video.
Okay, so there's a lot of negative feelings in general right now when it comes to how people are feeling about the economy. I mean, gas prices in the US hit $5 a gallon last week, and it's even higher in Canada at $2 a liter, so basically $7.50 a gallon.
$4 a gallon. And today, gas hit a new high, $5 a gallon on average.
Gas prices they're killing us.
Inflation is also at 8.6% in the US, and in Canada it just shot up from 6.8 to 7.7. And once again, we already talked about how the stock market is looking, which is basically red, negative, crashing, scary, basically all the above. Now, on top of all of this, last week we talked about how layoffs have already started to happen, specifically in the tech industry for now. We actually read that there are 95 tech companies in the US that have already started laying people off over the past few months, and at least 48,000 people have been affected so far. Zumper, which is a rental platform, said that they'll be laying off 15% of their workforce pretty soon, and it's also starting to hit Canada's tech sector as well right now. So we're seeing a whole bunch of hiring freezes, and some of the big players here in Canada are also starting to fire their recruiters, their marketing teams, and I'm pretty sure you guys have also been seeing all the LinkedIn posts of your friends or just viral posts in general of people being let go. Now, all of this is scary, especially the fears of you losing your job or not being able to afford gas, groceries, basically the essentials. What I will tell you though is that we're not covering this to scare you, but what you have to understand is that all of these different factors play into why there's a bear market going on right now and how the stock market is actually reacting to all of this. What's interesting about the stock market is how big of a part investors actually play. And yes, when I say investors, I mean you and me, assuming that you actually invest in the stock market, as well as all the other people who have investments anywhere from, let's say, individual stocks, ETFs to, other types of funds. Now, the reason behind all of this is because more people buying and investing brings up the value of the market. So basically more buying equals more value, and then the stock market rises. Now, on the other hand, when there's more people leaving the market, so selling their investments, or even just if they stop investing and hold without adding more money in, the value stops growing or even decreases. And we just covered how a stock market decreasing a lot, like 20%, leads to a bear market and market crashes.
Now, some of the major indexes being in a bear market right now is really showing us that people are scared about the market. They're worried about risk, and they're also selling off some of their riskier assets like stocks, for example. Now, historically, there's been a few different reasons for investors to become concerned and then start selling off their stocks. And one of those reasons is when they feel like the market's overvalued. Now, this is what we saw with the dot-com bubble. And depending on your age, you may or may not actually really remember it. But basically, it was when the internet was just starting to become a thing. And a lot of companies were just popping up all over the place, and they had these massive values attached to them because people were so excited about this new industry. Then, we the people and also the market overall realized these values are just too crazy high. And people started selling them off, the dot-com bubble burst, and the bear market started. Another reason is when people are concerned about the economy. Now, this is what we're actually seeing right now. And we've already kind of went over all of those different concerns that people are having and why. Basically, people are concerned about gas prices, high inflation overall, prices going up, and this plus some other factors have caused people to start selling off or stop buying stocks. And what's interesting right now is that a lot of people are also scared about a recession hitting, and people don't want to keep investing investing when the market's down and a recession's on the horizon because it's really scary to feel like you're losing money. And that's exactly what keeps the bear market going. And the bear market's only going to end when investors start to invest again. And people are only going to start investing again when prices are down and they're not as afraid for their jobs. And that's why the Fed's aiming to bring down inflation and prices, but more on that part in a bit. Now, something else that I thought was really interesting is that bear markets and recessions don't actually always go together. There's been 9 recessions during the last 17 bear markets. So even though a bear market could signal a recession, it's obviously not guaranteed based on those numbers. So let's do a really quick summary on all of that. Bear markets happen when investors are concerned about something, which could be high values or just the economy overall. Then they start feeling more uncertain and they feel really scared, so they end up dumping all their stocks and they either don't invest or they invest in safer options instead. So what actually turns the market back around, and how do bear markets stop, and how long do they even last?
Okay, so there's a few different groups that are involved in stopping a bear market, and that's the Fed, the government, corporations, and investors. Now, the official opposite of a bear market is a bull market. So that means when a market has actually rebounded 20% or more from its recent low point. So basically a full reverse in the opposite direction. If we look at the S&P 500 index, according to the Wall Street Journal specifically, it spent an average of 142 trading days in a bear market from actually entering it to exiting it. Now, keep in mind that that's an average. For example, the crash in 2001 took a lot longer to recover from, close to 5 years actually, because the growth was so huge, and then the crash was also really, really huge. So ultimately, the recovery just took a really, really long time. But on the other hand, the most recent 2020 bear market was extremely quick. It hit the bottom in only 23 days, and then it went back up to its high within 126 days, or in other words, 4 months. Now, like we said before, the Fed, the government, corporations, and investors play a huge part in every economic downturn and recovery, but 2020 was interesting because the Fed and the government stepped in really, really, really quick. So the Fed came in and lowered interest rates to motivate people to spend money, to make sure that businesses actually also continued to sell stuff and ultimately keep the economy running. Now, at the same time, the government handed out stimulus checks so people would have money to actually go out and, do that spending. So same goal of keeping the economy running, but 2 different tools to do it. The important thing to notice here is that even though the Fed and the government use these tools to help the economy, the biggest factor in turning around a bear market is still going to be arguably the people, so the investors. Now, this is because whenever they start investing again, that's going to be when the market starts to rise again.
So that's basically how the whole system works. It's based on investors getting scared, they stop investing in the stock market, everything ends up dropping, and then when they're convinced that everything's gonna be okay again, then they'll rebuy into the stock market and it makes everything go back up again. And if you're one of those people who ends up not selling and actually keeps investing during the lows, you're gonna see the best returns, at least historically, once the market does recover and it goes even higher as it always has in the past. So where are we at in the whole cycle of bear versus bull market this time? Some of the most recent news is that the Fed has increased the federal funds rate several times so far this year, and most recently by 0.75%, which is the most that they've increased it by that much in decades now. Now, typically when interest rate hikes are set to happen, the stock market actually falls before it's even announced because people know that it's coming from all the news. And you can even just look at the S&P 500 right before the May interest rate hike, and then again right before the June interest rate hike so far this year. Now, we saw in this Bloomberg article that for the S&P 500 index specifically, within 12 months of the first interest rate hike, the market goes back to growing again. And this has actually happened the past 8 times that the Fed's raised the federal funds rate like this. So basically, if we look at it historically, there's an 100% chance that the index is going to begin to recover within a year of the interest rate hike starting. Also, what's pretty interesting is that even though the interest rate hikes feel really high right now because they are high for single increases, overall interest rates are still fairly low right now if we compare it instead to past periods of rates going up. Overall, bear markets actually happen pretty often in our economy. And according to Seeking Alpha, the S&P 500 itself has seen 26 bear markets since 1928. And bull markets happen just as much, with 27 of them in the exact same time period. Now, recessions also happened at least once every decade or so historically. And according to the National Bureau of Economic Research, the US has been in a recession 14% of the time since World War II. So if this is anything like the past, then we will recover from this bear market. And if a recession does hit soon, then we're gonna recover from that too. And if you are someone who just doesn't move with the masses of investors and keeps investing in these passive long-term investments like funds that track the market that you always hear us talking about, then you should see the benefits of sticking with it.
Now, remember that all of these things that we're talking about are for you to consider, and it's important for you to not just take what we say or what anyone says as something that you just run with. You have to do your own research and you have to be confident with your own knowledge. Also, if you're young, remember that there's a lot of time for you to ride out the dips and the recoveries in the market. And if you're older, you want to continue to rebalance your portfolio over over time as you normally would, especially as you're approaching retirement. Now, with all that being said, guys, that's a wrap on this video. We hope that you guys enjoyed it. As usual, if you haven't already liked the video down below, if you haven't already subscribed, make sure you do so. Obviously, it helps out the channel a ton. Yeah, check out our previous videos next door, you know, over there, and we will be back. You know the vibes. Let's go.